I talk about the S&P 500 a lot on this channel, and I get so many questions about it. So it's about time for a specific video on the S&P 500 where I will be highlighting all the things that you need to know. And if you think you know everything, there are definitely a few things that will be interesting for you as well. First, I want to say thank you because at the time that this video was shot, I'm almost at 4,000 subscribers on YouTube. And since starting this channel 5 months ago, I have learned a lot. It's been a very rewarding journey for me, and I really hope that you enjoyed learning with me. So I'll be covering the basics of the S&P 500, and we'll also look at more sophisticated things. And the first thing to discuss is, what is the S&P 500? Don't let this abbreviation scare you, because it's actually quite simple. If you are considering investing in an S&P 500 ETF, or if you are already invested in one, these are all things that you need to be aware of. Just in case you're new here, I'm Carla, and I'm a chartered accountant and investment professional with 10 years of experience in the finance and investment industry. And the whole purpose of this channel is to help you make smarter money choices. So subscribe if that's you. First up, what does the S&P 500 stand for? Because sometimes people are overwhelmed by this abbreviation, and it's actually quite simple. S&P is short for Standard & Poor's, which is the organization that compiles this index. And I'll explain index in just a second. And 500 is the number of companies that is included in this index. So first, what is an index? An index is basically a basket of stocks, or you can think about it as a sports team. And instead of investing in a single player, you can invest in an entire team, which represents all of the players in that team. If we look at the S&P 500 specifically, for example, I mentioned that it covers 500 companies, and those 500 companies are the 500 largest companies in the US, and listed companies, I should add, because some companies are not listed and they are owned privately. Here's an image which simplifies to show you what the S&P 500 actually represents. So investing in an ETF that tracks the S&P 500, you will get exposure to 11 different sectors, including technology, financial services, healthcare, and consumer products. Therefore, this index is quite diversified, but you can clearly see that there is a big weighting towards technology. It includes popular names like Amazon, Google, Microsoft, Nvidia, Lululemon, Starbucks, and Coca-Cola. So why does technology have such a big portion in the S&P 500? The 500 companies included in the S&P 500 are included based on their market cap. And market cap is a term used to describe the value of a company's stock. And it's calculated by multiplying the share price of the company with the number of outstanding shares. As the share price increases, the market cap of the company increases. And because technology companies, especially in the US, have boomed over the last 20 years, the share of technology within the S&P 500 has increased significantly. And some people say this is very risky because tech stocks tend to be overvalued, because investors tend to see a lot of growth potential in tech stocks and are willing to pay a premium for that. But in my opinion, if you are always going to stay away from tech stocks, you are going to miss out on a lot of potential growth in the future, because technology and innovation is just here to stay, and it's going to continue to be a very valuable sector to invest in. And what's nice about the S&P 500, or any index really, is that it factually includes the 500 largest companies. It doesn't try to select which companies is going to perform better. And in the long term, there is data that shows us by just tracking an index, which automatically covers a market, as the US market in this case, you will be better off than trying to select and trying to pick which companies you think are better to invest in, because even professionals don't get that right. So the S&P 500 gives you exposure to the US market, but it actually has a much further reach than just the US, and I will explain that in just a moment. And just another practical thing to understand before we move on to the more juicy stuff is how an ETF works. So by investing in an ETF, which is an exchange traded fund, you will own a portion of that fund, which in turn will own the underlying stocks that represent the S&P 500. So by owning a share in an ETF, you get exposure to the 500 companies that are in the S&P 500, but you don't physically own each of those stocks. If this sounds risky to you and you're not sure if you can trust the S&P 500, we will also chat about that in just a moment. Because a question that I get so often is, what is the best S&P 500 ETF? All of these ETFs actually achieve something quite similar. There are a few things to watch out for, but I don't want you to get too overwhelmed with all of the different options and then not do anything. I would encourage you to try to find the lowest cost ETF that is available to you. And if you are doing this through a broker platform, which is usually the case, make sure that the broker doesn't have very high fees. So besides for the fees, there is not a massive difference between the different ETFs that track the S&P 500. But another thing also to look out for, depending on your location, is where the ETF is domiciled. And in basic terms, that means where the fund structure is registered, because that can become very important for your personal tax implications. When you invest in an ETF that is domiciled in the US, it could have negative implications for your estate when you pass away. But this is dependent on the country that you live in and also on the double tax agreements that your country has with the US. So how concentrated is the risk in an S&P 500 investment? There are two things to consider here. The first thing is where a company is listed and where the company operates and where it has revenue exposure to. Because a lot of companies list in the US, but they have global revenue exposure, as in the case of Google or Amazon or Nvidia. And if we could look at the global economy, you will notice that the US represents a big portion of the global economy, but there are also significant economies that you want to make sure you also get exposure to in case those economies experience significant growth in the future. Because on this channel, we are long-term investors and we want to think ahead 20, 30, 40 years. And what will the world potentially look like, and how can we be ready to capture some of that growth if it happens? Although economic growth is not always reflected in stock market growth. So even if you believe in the growth of a certain economy like the Chinese or the Indian economy, you are not guaranteed that that growth will be reflected in the stock market. There are many reasons why this is the case, but a lot of the economic growth sometimes happens within private companies or state-owned companies and not publicly listed companies. So therefore, as an investor, even if you believe in those growth, you might not be able to get access to it. But let's get back to the global exposure of the S&P 500. If we look at Google, for example, which is listed in the US but operates globally, half of their revenue comes from the US and the other half comes from EMEA and APAC. And this is the case for many companies listed in the US. If we look at this chart, which analyzes the revenue exposure of S&P 500 companies, this chart shows us that 59% of revenue from S&P 500 companies is linked to the US and 41% is linked to foreign companies. And this is a good way to show you how global the companies on the S&P 500 are and that they are not exclusively linked to the US economy. But the question still is, what are you potentially missing out on? If you want total diversification, you should also think about investing in an ETF that tracks non-US developed markets, that tracks emerging markets, and also small and medium cap companies in the US, because the S&P 500 covers the 500 largest companies in the US. So there are much smaller companies that could potentially have a lot of growth potential that you're not exposed to by just investing in the 500 biggest ones. But the S&P 500 is really not a bad index to start with, because I believe in the long-term potential of the US capital markets, and I believe that a lot of innovation will take place in the US and that the best companies in the world will continue to go to the US and list. And this is mainly from my experience in working in the venture capital industry before, is that once tech companies reach a certain size, they always have the prospects to move to the US and to grow further there, because it remains the biggest market for them and it also remains a good exit opportunity to list in the US. Personally, I know this is a bold statement to make, but I think that the best companies will continue to list in the US for the next 20 or 30 years. But still, there is a lot of growth potential in the Eastern countries, and you want to invest in a way that you make sure you get exposure to those. Because who really knows what the world is going to look like in 30 years? And why you don't want to miss out on emerging markets growth? Because if you look at this chart, which compares an S&P 500 ETF to an emerging markets ETF, you will see that there was a period between 2007 and 2013 where emerging markets actually outperformed the S&P 500. But after that, you'll see that the S&P 500 performed much better. I honestly think that we are in quite a privileged position to be able to make stock market investments in such a diversified and low-cost way. And I really hope that you take advantage of this. If you enjoyed this video, I think you'll enjoy this video that I made explaining my journey as a stock market investor, what I invested in, and also how I have burnt my fingers and learned from my mistakes. Thanks for tuning in, and see you next time.